All right, welcome to Talk Tickers. Today we are diving into what was a truly wild quarter from Bumble, that's ticker BMBL. The company just dropped a report that sent some major shockwaves through the market, so let's get right into it and break down exactly what happened. And when I say shockwaves, I absolutely mean it. The day after their earnings came out on March 11th, the stock just rocketed, closing up an incredible 34.2%. Now, a move like that is pretty rare, and it just makes you ask one really important question. How in the world did this happen? I mean, on a GAAP basis, the company lost over $4 a share. A number like that, on paper, looks like an absolute catastrophe. So what did the market see that headline number completely missed? Okay, let's dig in. To really get why the market reacted this way, we have to peel back the layers of the financials, because this quarter was just a classic case of a very mixed bag. See, once you look at the adjusted numbers, things start to look a whole lot better. Revenue came in at $224.2 million, which was a nice beat of almost $3 million. But the real surprise was the bottom line. Adjusted earnings per share of $1.07, absolutely crushing expectations of around 26 cents. So right away, that was the first clue that the real business was way healthier than that scary GAAP number. But, and this is a big but, here's the catch. Even though they beat expectations for the quarter, the year-over-year trends were, well, they were ugly. Revenue was down over 14%, and even more alarming, total paying users plummeted by over 20%. So how on earth do you square that with a stock that jumps 34%? This is where the story gets really interesting. Look, this earnings call had nothing to do with celebrating the past. It was all about selling a radical vision for the future. Management did an incredible job convincing investors to just look right past those awful user numbers and buy into a complete transformation story. And you have to give it to founder and CEO Whitney Wolfe Herd. She framed this perfectly. She didn't present these terrible metrics as a failure. Oh no, she presented them as the final, necessary pain of a deliberate quality reset. The message to the market was crystal clear. The hard part is over. And that's the key takeaway, right? This decline wasn't an accident. This was all by design. Management slashed their performance marketing budget by over 80%. They were intentionally ditching the old strategy of just getting as many signups as possible. You could say they were cleaning a house to build a much stronger, higher quality user base for the long run, even if it meant taking a huge hit right now. So, with the house cleaned, management turned the page to the rebuild. The entire focus shifted away from the old metrics and onto the product. Specifically, a ground-up redesign they're calling Tech Stack 2.0. And this is what that rebuild actually looks like. It's their new strategy, launching in Q2. And it's all about using AI to fix what everyone hates about online dating: endless, meaningless swiping. They're going beyond just photos and a short bio with these new story-based profiles and adding a bunch of AI tools to act like a personal dating assistant, improving matches, and maybe most importantly, getting people offline and on actual dates faster. And you gotta understand, this didn't just happen overnight. This pivot was a year in the making. It started with Wolfe Herd returning as CEO. Then came the tough calls, like cutting staff by 30% just to fund this big tech investment. And even as recently as last November, the market was hammering them for weak guidance. This earnings call really felt like the grand finale of that painful journey, setting the stage for the big launch in Q2. So, you've got this story of short-term pain for a long-term AI-powered gain. How did the pros on Wall Street take it? Well, it basically split the room. On one side, you have the bulls, the actual investors, and they went all in. I mean, look at this. The stock just explodes on crazy high volume, and call option activity went through the roof, which is always a sign of big-time excitement. But on the other side, the sell-side analysts, they were way more skeptical. A lot of them stuck with their neutral or underperform ratings, basically saying, that's a nice story, but show us the proof. Okay, so let's put all the pieces together. The numbers, the story, the market reaction. Here's our take on what to watch for as we head into the next quarter. You know, the investment thesis from here is actually pretty straightforward. The market is betting that the worst is officially over. The narrative isn't about bleeding users anymore. It's a tech turnaround story now. Management basically bought themselves some time. So what's the key risk? It's all about execution. Can they actually deliver a great product and get that user growth engine started again? So for Q1, yeah, the guidance was a little better than expected, which is nice. But let's be honest, nobody really cares about the Q1 numbers anymore. The entire game now is the successful launch of Bumble 2.0 in the second quarter. That's the only thing that matters. We expect the stock will probably bounce around here for a bit while the market just waits for proof that the new product is actually working.
So, wrapping it all up, we're initiating coverage with an outperform rating. We think management pulled off a masterstroke here. They took all the pain in one go, slammed expectations down to the floor, and now they've created a really low bar to step over. In our view, the risk versus reward here is now skewed heavily to the upside as they kick off this new product cycle.
And before we sign off, just one last, very important note. As always, please remember this is for informational purposes only. This is not financial advice. Be sure to do your own research before making any investment decisions.